Thanks for joining us. I'm Beth Parker with PENTalk. Let's just go over a few housekeeping items before we get started. First, we love questions, so please don't hesitate to ask. You can submit questions at any point via your control panel, and we'll answer them at the end of the presentation. We've created a copy of today's slide deck. It can be found in the handout section of the control panel. You may download it now or at any point during the call. As always, you'll receive an email tomorrow with a link to today's broadcast. Let's get started. We're joined today by our in-house expert, Rich Rouser, Senior Vice President, Client Services of PENTalk. Many of you know Rich, but for those of you who don't, Rich joined PENTalk in 1997 and has traveled the country visiting over 1,000 clients. One of his favorite things is to share his knowledge with others on the importance of retirement saving strategies, and as is the case today, share his knowledge of the retirement plan landscape. Rich, thanks for presenting. Let's get started.
Yeah, thanks for the introduction, and thanks everyone for attending this afternoon. This update is going to be a relatively quick one. I think we're scheduled for about 30 minutes total, but there's been quite a bit happening over the last couple of months in terms of rules and regulations and a lot of other things that have been going on in the industry. So just to kind of roll back to where we started the year, late in December, the Secure Act passed into law, and that basically is phasing in a number of enhancements to retirement plans and retirement programs, and that was really designed to increase retirement plan coverage in the United States. So there are a bunch of things that were coming into play in 2020, 21, and 22. For right now, today we're going to focus on a couple of things that are coming up in 2021, since we're almost done with this year. CARES Act was the second biggest thing that happened that impacted us all for this year due to the pandemic and coronavirus. CARES Act was passed on March 27th. I think it was a Friday night, as I recall. And that basically put in a number of optional relief methods that clients could adopt in their 401k plan. And we were pretty quick to let everybody know about that. I think 1.5 business days later, we were out with a webinar to clients and some material in terms of what some of the options were going to be. And I'll give you some updates on some of the statistics in terms of how many participants to date have taken advantage of some of those relief factors. The other big thing that happened just recently is the Department of Labor updated rules on selecting plan investments, and I'll go into a little bit of a dialogue on that in just a couple of minutes and let you know what that's all about, and we'll kind of wrap up with some of the pending legislation that's out there. I call it SSRA, Secure a Strong Retirement Act. That is a bipartisan bill that came out of the House Ways and Means Committee recently. So I just want to touch on a couple of things of the Secure Act, that are coming into play next year. I've got the technical detail here, right? Title I, Section 101 is TEPS, which is Pooled Employer Plans. Many providers are gearing up to provide PEPs starting in early 2021. The Department of Labor made a bunch of progress over the summer, and more recently, about a month ago, issued final rules on what it takes to apply to become a pooled plan provider within a PEP, and that was something we, as well as the industry, was anxiously awaiting. So we're planning on creating or being involved in a number of PEPs. We're planning on serving as a pooled plan provider, which is the principal fiduciary under those programs. And there'll be more news from us coming later this year and early next year on that development. Section 112, I'm going to hold off on that for a second. We're going to get to some details here, but that actually is impacting some of the, I call them LTPT, long-term part-time employees. And that was something that Secure put in place to allow these people to come into qualified plans and to at least save their own salary. Then there's IRS Notice 2020-68 that actually has an impact on how how the long-term part-time rules apply. And they talked about in that notice a couple of other things, which we'll go through. QBODs, which I love the acronyms they come up with, but that has to do with qualified birth or adoption distributions, which is something that came out this year. Okay, so let's get into a couple of the nuts and bolts. I mentioned this a minute ago. PEPs are going to be effective next year. Basically, they are similar to a MEP, which is a multiple employer plan, except for the fact that unrelated employers or plan sponsors can participate. You know, right now, Pentegra runs a couple of closed MEPs, some very, very large closed MEPs, primarily for financial institutions, banks, and other financial institutions. So an open PEP or an open MEP or an open PEP, as I should say, actually could allow other non-financial type companies to come into the program. So that's kind of on the drawing board, more than on the drawing board, and we're going to be involved with those. As I mentioned a couple of minutes ago, one of the biggest concerns that was out there is the one, we call it the one bad apple rule, and that's if you have one plan sponsor that is not complying with the law or not complying with the terms of the plan document, in theory, that could have tainted the plan or tainted the rest of the employers in the program. So that was kind of dealt with in the Secure Act and under PEP, so that clears up one of the issues there. The other thing that was put out in Secure under Section 112, which allows long-term part-time workers to become eligible for their 401k plan. And this was really put into the law to address a concern that, you know, there are a fair number of people in this country who relocate for a variety of reasons, and you know, in many cases they never really work enough hours, or truthfully, they're part-time employees too, which is the other issue. Therefore, they never become eligible for their employer's plan. So Secure tried to deal with that by changing eligibility rules. And I know I've covered this on prior webinars, so I'm not going to go into I'll go into a little bit of detail today, but essentially what the rules said is in addition to your normal eligibility rules, right, which you know, could have an hours requirement, could have a length of service requirement. You need to look at those normal eligibility rules, but also you need to say, hey, if an employee has 3 consecutive years of service with at least 500 hours of service, they'd be eligible to come into the plan. Now, the way it would work under Secure, I think we actually have an example coming up here. Here's the example. There we go. So the way it would work under Secure is, you'd start to count hours for these people starting in 2021, and again in 2022, and again in 2023. And the first time they would be eligible, if they're coming into the plan, under a Secure Act eligibility requirement, is 2024. It's the first time they could come in. So that rule is there. It's still in place, and the whole concept of counting hours would really begin next year, meaning 2021. I'm going to get to what happened with one of the recent IRS notices, but they changed the rule, not so much on eligibility, right? These people are still potentially going to come in 2024 if they meet these requirements or the normal eligibility requirements for your plan. But they did change with respect to how vesting works with those people. So we're going to get to that in just a minute or two. So the one thing I want to leave you with today, because I think the most important thing today is to start to think about, number one, do you have any part-time employees on your staff? And if the answer is yes, you need to start to think about, are they ultimately going to be categorized as long-term part-time, right? So you need to start to think about tracking hours, and more in particular, once we get to 2024, there's going to be a need to go back at least until 2021 and 22 and 23 to look at the hours worked to see if these people have worked more than 500 hours in each of those 3 consecutive plan years. So in the end, if the answer is yes, then they're eligible, right, for the plan. So again, this is all normal Secure Act law and provisions, right? So that part of it seemed pretty straightforward and pretty easy, and everything is prospective in nature, meaning I don't have to count those hours till next year. I'm going to get to the twist in just a second. Now, you might say, well, wait a second, isn't that going to negatively impact maybe testing? What if these people don't want to participate in the plan, and there's zeros, and now they count as non-high paid zeros and hurts my testing? Well, again, Secure Act basically said you can exclude those people for testing, right? So that won't be an issue. So here on this page, I've got a lot of the rules on. We're not going to go through them one by one. That's not the point of today's discussion. Today's discussion is really, hey, what do you need to be aware of? What's coming up next year? And by the way, you don't have to give these people employer contributions of any sort. No, you don't have to provide a matching contribution. If you make any supplemental or profit sharing type contributions, you don't have to give these people any of those contributions. And again, they're excluded from testing. Now, if you said, hey, you'd like to provide a match, or if you'd like to provide profit sharing or some other type of employer contribution, you can certainly do that. That would have to just be folded into a plan amendment. And speaking of plan amendments, all of the required amendments for Secure Act, and by the way, for CARES Act, they finally brought that into, they synchronized it for both, thankfully. So any amendment work needs to be completed by the end of the 2022 plan year. So there's plenty of time on the regular amendment work. The only thing we as a record keeper would need to know, or if you're using some other record keeper, you need to make sure they have a clear understanding of your intent. And quite honestly, if you want to give any sort of employer contribution to those people, you'll have to do an additional amendment beyond the plain old Secure Act amendment to make that part of it happen. So, start to be aware of what you need to do from a internal record keeping standpoint in terms of counting those hours. So here's a little commentary on IRS Notice 2020-68, came out on September 2nd. As I said, between the federal government, or Congress, I should say, in terms of lawmaking, the IRS and DOL have been incredibly busy in 2020. So this came out in early September. It gave us additional rules for LTPT, long-term part-time. I'm going to get to that in a second. And QBODs, qualified birth or adoption distributions. There are some clarity around both of those. Another thing that Secure Act did is permit ongoing IRA contributions for participants, or people, I should say, who are still working beyond 70 and a half. Previously, that wasn't permitted. So if you happen to provide IRAs, for example, to customers or clients, the notice made it clear, right, that financial institutions are not required to continue to allow people to, make IRA contributions beyond 70 and a half. But this notice does make it clear that if you do want to allow IRA owners, to make continued contributions, you do need to amend your IRA contracts and customer disclosure statements. So we don't necessarily get directly involved with IRAs at all, but many of you do. So that might be something to look into to see what your intent is there. And this notice also said that the amendments and updates can be deferred until the end of 2022. So I'll leave that part to, again, if you're providing IRA services, you'll have to look deeper into that side of the business, if you will. So the other thing Notice 2020-68 gave us is, I've got it highlighted in blue, for these long-term part-time employees, including people hired before 1/1/21, you got to take into account all years of service for vesting. Now, the concept of vesting, if I go back to the beginning of time on qualified plans, it's always been a premise that you count all years of service for vesting purposes. Now, that wasn't clear under Secure Act, because Secure really just focused on, primarily on eligibility, right? And the fact that, the earliest these people could come in under this Secure Act eligibility rule is 2024, and you needed to count hours of service beginning January 1 of this coming year. So again, that part of it seems pretty easy. As long as you know about it, you'll start to track hours and hopefully have what you need, at the end of 2023, so we can figure out who of them need to come into the plan. But this notice made it crystal clear that you've got to take into account all past years. So you might have had somebody who is technically a long-term part-time employee who's been on board for 5 years already and will be on board maybe another 3 years by the time we get to 2024. So, for example, if you have a 6-year graded vesting schedule, well, guess what? By the time they come in, they're going to be fully vested, because, the Secure Act special eligibility and now this notice highlights the fact that you got to count all years of service in which they work more than 500 hours, right? So that's the key trigger: more than 500 hours for eligibility, and more than 500 hours retroactive even for vesting on these people. So to us, that was kind of a little bit of a surprise. You could argue it's not a surprise, because historically all service counts for vesting, but it is a little bit of a surprise because, what we found is a lot of employers don't necessarily have a whole bunch of retroactive records. I hope that's not the case with anybody in the room that has to actually count this for 2024. But if you think you're going to have a problem digging up those old number of hours worked, now might be the time to think about a solution. I know the IRS is actually, looking for some comments on this, and I don't know if there's going to be any relief on it. If you kind of said, hey, we don't really have payroll records, or excuse me, you probably have payroll records, but maybe not the hours worked historically. So maybe they'll come out with relief. Knowing the IRS, the relief could be as simple: well, if you don't have the hours, just assume they work more than 500 hours. Well, that may or may not be the optimal solution for you. So anyway, just a heads up. That was definitely something we didn't necessarily contemplate when they passed Secure Act. Okay, so for QBODs, again, I stumble when I say it, qualified birth or adoption expenses. And again, we've talked about this in prior webinars, but essentially it says if you have a birth or an adoption that occurs essentially this year, you've got 12 months after that birth or adoption to potentially take a distribution from your qualified plan of up to $5,000. And, so when you think about that, well, okay, fine, they take the distribution. And what does it do? It gets you out of the extra 10% additional tax for early distributions. But anyway, this notice, and by the way, just another quick comment on the adoption: the 12-month period for taking that distribution begins not on the birth of the child, but after the adoption is finalized. Just one of those technical things to kind of keep in mind. And they have very specific rules on the adoption. I'm not going to go into this now. I know we did that in the prior webcast. So just if you have anybody in that category, they just need to know there are special rules that need to be looked at. But again, plan sponsors are not required to permit these distributions. We do have at least one, I think maybe even two clients that asked us about this, and I think one actually took one of these distributions. But what this rule basically said is that participants, let's say I'm a participant in the plan and I previously took an in-service distribution that otherwise met whatever those rules were. Well, I can actually, whether or not your plan allows me to take a QBOD, I can actually count it as that, as an individual participant when I do my taxes. That's kind of the nuts and bolts of this whole notice. So again, I don't think that's anything for you as if you're a plan sponsor. I don't think it's really anything for you to worry about. That's going to be something for the participants to sort through. As with other guidance we've gotten from the IRS, you may do or whoever the record keeper is or custodian is, may do a 1099 showing that distribution as a pre-age 59 and a half distribution with no known exception to the 10% extra tax. Again, other guidance from the IRS says, hey, that's still up to the participant. You're not going to, whoever prepared the 1099-R is not going to have to, do an updated 1099 to reflect that. That's going to be a personal item that the individual participant reconciles on their tax return. So, again, they're limited to $5,000 within 1 year of birth or adoption. We should put the word eventually, finalization of the adoption of the child of a participant. And again, there are some arcane rules here. I think, for example, it can't be a child of your spouse, something like that. So there's some things in there. This is really kind of, referring to, a pure, I'll call it third-party unrelated adoption, if you will, if that makes any sense. If you want more clarity on that, give me a call. We can work through the details. It's pretty straightforward when you see it all in writing. Anyway, the other thing this notice does is it says it applies per child, not per birth or adoption. So again, this thing just gave some clarity, and the bottom bullet that I just put up, you as a plan sponsor can accept a participant's self-certification that this event has taken place, right? You don't need to get a copy of a birth certificate as proof. You don't need to get a copy of adoption finalization paperwork or anything like that. It's self-certification, which is kind of what they did with other provisions in the CARES Act, right, when it came to corona-related distributions. And I think one of the last things it did on these is basically say, it also would require the ability to roll it back over into the plan if your plan otherwise permits rollovers. Most plans do, or they can potentially roll it to an IRA account. So they can repay it if they so choose, and that's how that stuff works. A bunch of other notices came out. I'm going to go through them. Some of these are going to be pretty quick. Additional guidance for CARES Act related distributions, CRDs is what I call them, and Corona related loans, CRLs. Two big changes. Again, we reported on this one previously, and that was one of the biggest problems with these relief measures. We were getting phone calls from participants saying, hey, my spouse was laid off due to the pandemic, or my spouse, got the coronavirus and therefore can't work, therefore doesn't have enough income, therefore it's right. So can I take a CRD or corona-related distribution or a loan? And the answer by the law was no. I'm sorry. So IRS did come out and basically say, qualified individuals is a member of the household, but we knew that already. And we also know that the fiduciary of the plan doesn't have to do absolute confirmation, and it's also self-certified. So this notice 2020-50 tightened up tax reporting, in terms of the proper 1099 tax codes to use. Again, participants can claim a corona-related distribution that might be contrary to the plan and tax reporting, meaning 1099-R says that it was a hardship distribution with no known exception. Again, it's self-reporting, and you're not going to have to do revised 1099s, and the participant will be able to, I assume, check boxes on their tax return to straighten that part of it out. I guess the one thing that I'll mention is of the four optional, well, there are four primary things impacting qualified plans in in the CARES Act. One of them was basically saying, look, minimum required or required minimum distributions for this year are to free pass, number one. Three optionals were corona-related loans, corona-related distributions, and extensions of other loans already in the plan. So of those three optional features, one of them has already kind of seen the beginning and the end. That was loans. Corona-related loans were only available for a 180-day period. That 180 days ended September 22nd. So that leaves corona-related distributions, which can occur as late as December 30th. Don't ask me why they didn't say year end. I haven't checked the calendar. Maybe year end is Saturday. I don't know. But they said December 30th. And the other thing is you can technically still do a loan extension of any loan that's in existence under the plan through the end of the year. So those two options are still out there. I'm going to show you some stats, I hope, in a minute here. Let me hopefully get to stats. So this is kind of an interesting look of where we are to date. We've processed nearly 4,000 corona-related loans or distributions, and you can see the dominant number of them were really tied into the distributions, and that kind of makes sense. Distributions don't have to be repaid, so it's more flexible than a loan. Distributions are taxed over a period of up to 3 years at the participant's discretion. They can pay the tax all at once, but they could spread it over 3 years. And by the way, they can repay the loan to the plan. So that's kind of interesting is the point. And by the way, the stats are interesting. I've looked at other retirement plan providers, and our stats here are pretty similar to what we see across the industry. The other thing I want to talk about today, and I know we're getting a little close on time. So by the way, if you have questions, hopefully you're putting them out there. I don't know how many we'll get to today, but we will answer every question that is submitted, just so you know. So even if we don't get to it live, we will get to them. So the DOL over the summer, back in August, was kind of on a mission to kind of codify, I should say, or finalize some rules on. They kept using ESG as the terminology throughout, the proposed final rulemaking that came out in August. Now, that proposed rulemaking was kind of a next step from their original proposed rules, which I think were done back in 2013. So, we've been waiting 7 years for the next step, and it finally came in August. And they published the proposed rules in August. And this is related to initially socially conscious investment funds, ESG type investments. And throughout the literature that they published in August, it was ESG this and ESG that, and anyway, industry. I think there were 1,100 comments to that proposed rulemaking, and more than I've seen in the retirement space in years. I don't think I've ever seen 1,100 comments, and they were mixed. There were some on the side of, hey, we should be able to do whatever we want in terms of putting socially conscious investment funds in the plan, and others in the industry who said, no, you shouldn't. So the final end result, no big surprise, is what I have here. DOL came out in the final rule, which was published finally in the Federal Register. I think it was September 13th. I'm sorry, November 13th it was published. So they said, look, here's the bottom line. Follow ERISA, right? Be a faithful fiduciary. In essence, what that means is do what's in the best interest of all plan participants. And if you're using metrics to select your investment funds that are not economic or financial metrics, in other words, a lot of socially conscious funds actually will say in the prospectus, by investing in this fund, your investment returns may be lower than equivalent funds in the category, right? Some of these funds also say your expense ratio may be, in fact, be higher. So funds that have a particular angle, certainly that go out of their way to put that disclosure in a prospectus, are, in my view, as a personal view, going to be problematic. So they said, be a faithful fiduciary. And again, truthfully, that's no big surprise. Choose investments without compromising the investment selection. But there was one big, I should say, little surprise. The DOL in the final rule removed all reference to ESG nomenclature. They basically said, you know what? Because again, it's interesting. Some of the commenters said, well, what's this whole thing got to do with ESG? It really has nothing to do with it. Really, the fundamental rule as a fiduciary, an investment fiduciary in particular, is do what's in the best interest of plan participants, screen your funds, select your funds based upon criteria that are economically and financially sound. And anyway, they removed the ESG in particular because it was proven to them that it's not just ESG that they should be focusing on. It's not a witch hunt to go after ESG. But they made it crystal clear the funds must be assessed in a pecuniary manner. So they go out of their way to say that. Now, what has the DOL done in terms of, the final rule? You can see the top bullet here. Final rule doesn't prohibit selection of a fund that has ESG characteristics. But they are crystal clear that says, hey, if one of those types of funds ends up on your platform or in your portfolio for selection at the participant level, you better be able to prove it is better than others in the category based upon your normal financial and economic selection criteria. So that was one thing they said loud and clear. They also said they're not going to enforce these rules retroactively, which is a good thing. They're not going to go look at what you had last year or the year before. But they are going to, trust me, they are going to enforce this on audit on a go-forward basis. And they make it crystal clear you better have documentation if you have a fund that could fall into, a category where they've used non-pecuniary methods to select that fund. So timing-wise, by the way, they also said it's not appropriate. These types of funds are not appropriate for qualified default investments. So that's crystal clear here. So timing-wise, new rules effective 60 days after published in the Federal Register. So again, it was published November 13th was the day. So if you actually count days, I think January 12th is the final due date. Meaning if you just have funds on the menu, you better prove that they can stay there or remove them from the plan. Now, for QDIAs, if you have any of these funds in a qualified default investment structure, right, those are the investment funds that participants default into to the extent that they don't make a decision on their own. Looks like we're a little over time, so we're almost done here. They basically gave a longer period of time to remove those from the plan because a lot of the commentators said, hey, you know what? There's a whole process that we use to determine how that works. We're going to need more time. So the DOL was definitely listening to the industry or listening to firms that use those types of investments in their lineups and said, hey, if it is in a QDIA, you do have a bit more time. You've got until April of 2022. So, with that said, a ton of activity from IRS and the DOL, let alone Congress and others in the past 10 months here, 11 months. There's definitely more to come. I mentioned earlier today, SSRA is proposed legislation. It's got 34 items. Everything in it is pro 401k, pro retirement plan. Not a single thing in that proposed legislation that almost anybody could say is not a good thing. It is all good stuff. Favoring participants, favoring plan sponsors, giving extra tax breaks to both, creating potentially additional catch-up contributions for older individuals. So there's a lot there is the point. Now the question is it really going to make it into law? I look at something like this, and I say, well, these additional tax breaks are going to cost the government revenue. And typically when it costs revenue, they need to find that revenue somewhere else and make it maybe revenue neutral. So whether or not it's actually going to come into law, I don't know. It was bipartisan, which is a good thing. And it's possible under a new administration that something like this might actually get done. In particular, if there's changes in federal, corporate tax rates, if they go up to some of the old corporate, tax rate structures, maybe that is a way to find some funding for something like this. So, Beth, I think we are at time on this. So is there maybe one question you want to give me that we can answer, and the rest we'll have to send to the group after the fact?
Okay, one question that we'll answer is, do you think that the ESG rule will change with the Biden presidency?
That's an interesting question, too. I don't think so, actually. I think the DOL in the rulemaking, in the proposed final rules in August, actually was kind of piggybacking on some of the line of thinking from the Obama administration. So if there is a new administration, I'm not sure that the final votes are really in yet, but if there is a new administration, I would almost tend to think it would be kind of a continuation of the Obama era line of thinking. So my thought is no, it probably is not going to change. Anyway,
all right, very good.
I appreciate everyone's time today, and we'll follow up with answers to the other questions.
All right. Thanks, everybody, for joining.